Hi students, today we're going to look at a number of journal entries that will provide an example for the purchase of merchandise and then the reselling of the merchandise to your customers. So this is around, of course, inventory, and many businesses today are retailers of some kind or even wholesalers, and they all have accounts payable and accounts receivable. So we're going to look at both of those, and I've set these up so that we can do all our accounts payable first and then all our accounts receivable later, just to sort of keep them straight in our mind. Now, one thing to note is we're using the perpetual inventory system. There's also a system called the periodic system, but the thing is, with computer software today and accounting programs being so good, very few companies still use the periodic system. So most introductory courses don't even teach the periodic system. Sometimes you see it at the appendix of a chapter, but for the most part, we're just looking at the perpetual system. So one of the characteristics of the perpetual system is that every time you sell goods, you also at the same time prepare an entry for your cost of goods sold. So your cost versus your sale amount. Now that is two separate journal entries. And we're also going to look at purchase and selling terms. So if you read your textbook already, you probably saw terms such as 210 net 30 that I have right here, this first one. So 210 simply means that the buyer, in this case, will receive a 2% discount if they pay within 10 days. Now, if they don't pay within 10 days, they don't get a discount. So net 30 means it's due in 30 days anyway. They have 30 days to pay the full amount, or they have 10 days to pay the discounted amount. So let's dive into some of these journal entries, and we're going to go through all of these that are very representative of normal buying and selling. So first, we purchase merchandise on account 400, to terms are 210 net 30. So when we purchase merchandise on account, we're usually going to just debit inventory and we're going to credit accounts payable. Now, the vast majority of companies are just going to record this this purchase at $400. There is another method that's not very well used where you would assume you're going to take the discount and 2% of 400 being like $8. You might record this at $392 net and then charge another account if you don't take the discount. But we're going to do it the normal, simple way. We're just going to record the $400. Now, let me just make sure I get this all formatted. And here's our 400. Oops. Yeah. Okay, so that's our first journal entry. Now, second entry, we purchase merchandise for cash. So of course you might have got a discount for paying cash, but it's already reflected in the $700 price. So that's March 7. And we're going to also debit inventory again, and we're going to credit cash. And that was $700. Okay, so nothing groundbreaking yet, right? So let's look at the payment of our, sorry, we're not there yet. Excuse me. We have one more to do. This is on the 9th. Purchase merchandise on account for $1,000. So once again, we're going to debit inventory. We're going to credit accounts payable. And I have it here, so I might as well use it and just copy that in. So this was $1,000. All right, so now this is where things start to get a little bit different, maybe a little bit interesting. So on March 10, this would be our customer we returned $200 of the March 9 purchase as it was the wrong item. So we bought the March 9 $1,000 of goods, but we've just returned 200. So basically that just means you don't owe that money anymore. So on March 10, we have the opposite thing happening. We're going to debit accounts payable. And because we don't have those items anymore, we're going to credit inventory. And it's at $200. Okay, so that was March 10, but what happens on March 12? On March 12, we're paying for the March 4 purchase. Now, did I say 4? I should have said 5. Excuse me. March 5 purchase. Okay, now what you might note is that March 5 plus 10 days is March 15. So we have until March 15 to take the discount, and we're paying it on the 12th, so we're going to take the 2% discount. And our 2% discount is 2% of the $400 in this case. So that's an amount of money we're not going to have to pay. Let's look at how we journalize that. We're paying off our accounts payable. And our accounts payable is $400 right here. So if you were to do a T account of accounts payable, you would see your balance is, the 400 plus this 1,000 minus this 200. But that particular purchase was $400. So we're going to pay off the $400. Now I'm going to leave a space here for a second. We'll get back to that space, but we're paying cash to pay it off. And you'll notice that the 2% discount gave us $8 off. So we're going to pay $392. And $392 is going to clear off our $400 because we're getting the 2% discount. Now the difference is $8. And the thing is, we need to have an account to credit. Now, under the perpetual system, this means that in fact we didn't pay as much for our inventory. So what we're going to do is we're going to credit inventory. Now this is different from the periodic system. If you were studying the periodic system, you would have an account called purchase discounts. But under the perpetual system that we're using, there is no such account. There's no account called freight in, which would be from the periodic system, and there's no account called purchase discounts. Everything is adjusted through inventory. So our inventory, instead of being 400, is now 392, reflecting what we actually paid. Okay, now let's look at March 19. Paid for the March 9 purchase. Now, the March 9 purchase was $1,000. And keep in mind, check for returns. We returned 200 of this on March 10. But in terms of days, March 9 plus 10 days is March 19. So we have until March 19 to take the discount, which we will do. However, keep in mind also, you cannot have a discount on the merchandise you returned. You only owe $800 to these people. So we're going to use the same account titles to pay, because we're paying and we're paying within the discount period. So I have the same, well, let's try this one again. Oh well. Doesn't like that. And there's the 19th. Okay, so keep in mind, you don't want to forget if there was a return. We only owe 800, so we're going to pay off the 800. Now, one thing you cannot have is you cannot have a discount on merchandise that you returned. So we're talking about 2% of $800 owing, not 2% of 1,000. So 2% of 800 is our $16. So we're going to credit inventory for 16, and then we're going to pay the rest in cash, which should be $784. So now we've paid for everything that we purchased. Okay, that set of entries is very representative of any of the entries you're going to see asking you to prepare entries for accounts payable and the purchase of merchandise. So now let's move to us, or our company, selling these goods. Now what you'll see is that, again, every time you sell merchandise, you have to have a corresponding entry for cost of goods sold. And what we're going to do is we're going to take it out of inventory, our asset, and we're going to put it into cost of goods sold, which is essentially an expense account, and it goes against the sale. So here on the 20th, we sell merchandise for $900 cash, and our cost is $400. Now, what I'm just going to do to minimize flipping back and forth here is I'm just going to recopy these here, and that'll make it easier. So March 20, we sell merchandise for cash. So we're going to get cash, and we're going to credit sales. And again, it's cash, so we don't have to worry about any discounts that we're going to give in the future. And that sale was $900. So don't get these mixed up. Your selling price is $900. Your cost is $400. So the next journal entry is for $400. And if we were looking at this in a very tiny way, note that you earned a gross profit of $500. So selling price minus cost is gross profit. That $500 has to help pay for all your other expenses and hopefully give you a profit at the end of your accounting period. But just the same, let's look at the next entry. Here's also in the 20th, and we have to have an entry to debit cost of goods sold. And note that cost of goods sold acts like an expense account, so it has a debit balance. But what do we not have anymore? Well, we don't have inventory anymore. And that was $400. So this is showing our inventory going down and the cost of sales going up. All right, now let's look at the next transaction. On March 22, we sell merchandise on account for $1,500. Our cost is $800. And this time we're giving selling terms $210 net $30. Now it means the same thing, except this time we're going to give our customer the discount if they pay within 10 days. So maybe they will. So let's look at our transaction on the 22nd. We have selling merchandise on account. So we have accounts receivable with a debit, and we have sales with a credit. And this is the selling price, not the $800, the selling price of $15. So here's my $1,500. And just like before, we have to have the second entry for cost of goods sold. Now, I already have this typed in, so I'm just going to use it. So there's cost of goods sold, and this time it was $800. So let's look at what happens next. We sell merchandise on account again for $2,000. Cost $1,200. Terms, same thing. So here's a sale on March 24. Now, you may be doing this by hand, or you may be doing it in a Word table. I would suggest that you do your journal entries in a Word table. The only reason I'm using Excel in these videos is just in case I have to do a quick calculation and show you in the video how that works. Otherwise, I would be using a Word table to do these because it works out really well. And just as in Excel, if you have a repetitive use of your account titles, you can just copy them in. So in a Word table, this would be 5 lines, 5 rows in a Word table, and I can just copy it in because it's also a sale on account, and I also have to do the cost of goods sold entry. If you do that, just be careful you don't get mixed up. It's easy to just start copying and then not really notice if you have the wrong account title. Okay, but in this case, our sale is $2,000 and cost of goods sold is $1,200. So here we have our $2,000 and we have our cost of goods sold, $1,200. Okay, now that takes us through all our sales, but we're also going to look at, what happens if a customer returns goods to us. So just like when we're buying goods, if a customer return goods, we're not going to give them a discount on the amount returned. They only can get their 2% discount on the portion they kept. But there's another thing we have to think about, an extra thing we think about for a sale. If you can think about returning goods, you may have sometime in your life returned goods. Now, was it broken because you just started to use it and it broke and you returned it? Or did you just not like it, but it worked fine and you returned it? So this is a big difference, because if a customer returns goods and they're perfectly fine and not broken, we're going to put them back into inventory and sell them to someone else. That means we need a journal entry to put them back into inventory. However, if someone returns goods to us because they're broken and unsellable, then we're not going to, of course, put them back into inventory, and there is no second journal entry. We have to absorb that loss, and it's already recorded in cost of goods sold. So if you see a sales return, just make sure you look to see if the company returned those goods to inventory. Then you need a second journal entry to put them back. If they did not, you do not need a second journal entry. Now let's look at what happened. Customer from March 24 returned $500 in merchandise. We just shipped them the wrong color. So the implication that this would be perfectly fine, and we're going to put them back into inventory. But first, let's do the entry for the return of $500. So on the 27, we no longer have a sale, do we? But we don't debit sales to reduce it. We debit a new account, sales, returns, and allowances. And we're going to credit accounts receivable because they don't owe us the money anymore. So we've dealt with the return in terms of the account receivable, and we've recorded the sale return under the account sales, returns, and allowances. Now, just for your information, the allowances part of this name refers to a situation where they didn't return the merchandise, but there was something they didn't like about it, and you said to them, well, keep the merchandise and I'll give you like $100 off. So in this case, it was the wrong color. But let's say they didn't really mind the color. So they phoned you up and said, hey, you shipped me like, let's say green Halloween decorations, and I wanted orange Halloween decorations. And you say, well, rather than return them, what if we give you $50 off the price? And they might take that. In that way, they don't owe you that $50 anymore, and you use the same account to debit sales returns and allowances. Most of the examples you see are just going to be a straight up return. Okay, we're putting these back in inventory. What was our cost? Now, sometimes this is given to you in a question in your accounting class. Sometimes you have to figure it out. And here we're going to figure it out. It was a $2,000 original sale, and they returned $500 of merchandise. If our gross profit percentage is constant, then the $500 is 1/4 of that order. And 1/4 of our cost of 12 is $300. So we just figured out that we're putting $300 of goods back into inventory. So we need to do that also on the 27th. And just like this account, this entry here, debiting cost of goods sold, crediting inventory, we're going to reverse it. We're just going to put it back into inventory right there, and we're going to credit cost of goods sold. That could have worked a little better, but there we have it. So we calculated that amount as $300. And there we have it. Now that was the entry on the 27th. So now we're going to get payments. Notice on the 28th, we're paid for the March 22 sale. That's well within the 10 days. And on the 31st, we're paid for the March 24 sale, also well within the 10 days. So this means in both cases, we're going to give these customers a discount. So let's look at the simple one first. Receive payment for the March 22 sale. Now the March 22 sale was $1,500. So they get the 2% on the sale amount. So what we need to notice that first, our accounts receivable for this customer is $1,500. So I'm going to build this journal entry, and let's look how this is going to go. So we're going to get cash, and down here they're going to pay off their accounts receivable. Now their accounts receivable was $1,500. These people didn't return anything, so they owe us $1,500. So I have to credit their accounts receivable with $1,500. But how much cash did they give me? Well, I'm just going to do this here. I think we can do this in our head, but just in case, we're going to take $1,500 and we're going to multiply by 0.02 or 2%, and that's $30. So the discount is $30. Now, if I take the $30 discount away from the $1,500, that's $1,470 that I get, and the discount of $30, I need this to be a debit, and think of this, it reduces your sale. You originally sold $1,500, but you just gave them $30 off. So in fact, your sales amount went down, but just like returns, we don't debit sales. We have another account to debit, and that is simply sales discounts. So simple enough, right? Every discount is a debit to sales discounts. Now your net sale is $1,470. So we just have one entry left, and that is on the 31st. So our customer paid us. Now keep in mind, this is the customer that returns some goods. So we might have to look back here, but notice that we sold them $2,000 worth of goods and they returned $500 worth of goods. So very similar to the other customer, they actually have an accounts receivable balance of $1,500, right? The $2,000 sale minus the $500 return. So let's get our money from them and they're going to give us $1,500 less the 2% discount. Now, coincidentally, it's all the same numbers as the previous example. 1,500 times 2% being 30. So lucky us, we can simply take this and copy it here because it's the exact same amount. Okay, so this set of journal entries, once again, is going to represent pretty much all of the journal entries that you're going to see around selling merchandise in an introductory course. So we've looked at the journal entries for you to buy merchandise, return merchandise, and pay for merchandise, and we've looked at also journal entries for you to sell the merchandise, accept returns, and provide discounts and collect your money. So that's pretty much it for the inventory section, and in the next video we'll be looking at a new topic.